You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey, the Wealth Formula Podcast, and today I'd like to remind you of a few things before we get started. First and foremost, there's a website called wealthformula.com that is associated with this particular podcast, Wealth Formula Podcast. There's lots of things for you to enjoy there, lots of free stuff. And if you're like Bernie Sanders or Elizabeth Warren, you know everybody likes free stuff. So it's an easy way to get people to do stuff. Anyway, this stuff is actually useful and it is not wasteful. And so you should go check it out, wealthformula.com. Free books, lots of information, the opportunity to sign up for the Accredited Investor Club, which is cranking it out. End of the year stuff, lots of tax advantage stuff, lots of real estate. We don't slow down, right? Because your money should not be slowing down. It shouldn't be sitting there lazy. And so that's the reason we're constantly looking to find interesting stuff. And if you are an accredited investor, you should certainly consider joining us at the Wealth Formula Investor Club, because that's where the magic happens. And you can sign up at wealthformula.com. Also, as a reminder, since people have brought this up, our next meetup, save the date, okay? It's March 14th. It'll probably be 13th and 14th. And it'll probably be in Phoenix, Scottsdale, that area. In fact, I know it will be because I've already I just invited Tom Wheelwright and Doug Lodmell there to be there already. We're going to have some different folks this time as well. But, you know, some of the foundational stuff I think is important to have. We own lots of real estate in that area through the Accredited Investor Group. So it'll be fun to go tour some of those things as well. So just mark it on your calendar. Don't be surprised. Don't say later, hey, I wish you'd told me about it. And I know there's already people saying, it's not a good week for me. That's not a good weekend for me. But you know what? We got to pick something and we have to stick with it. So it is what it is. And we'll leave it at that. Now, as far as today's show, you know, I want to talk about this concept of crowdfunding platform. So since that whole jobs, it's not the jobs. Anyway, there was just some huge amounts of legislation during the Obama administration that got regulation, crowdfunding, and that sort of thing approved. And all of a sudden you saw everywhere, you saw these crowdfunding platforms and portals. And that's what happens whenever there's an opportunity for people to, potentially make a profit in a new niche. And so, since that time, though, I always get this question. I get it all the time, probably at least once every couple of weeks. And I'm not saying it's a bad question, but here's the problem, right? I get this question. People say, what do you think of, and then they say some catchy platform name. What do you think of this, Fundrise or this, that, and the other thing platform? And then, what platforms do you like? What do you recommend? And when I hear that, the problem with it is really the question itself, right? It's not really asking the right question. So I am a real estate investor. I'm a real estate professional. And when I invest in real estate, whether that is, as usually as a general partner, or if I buy my own assets, or even as a limited partner, I am looking at the asset itself. One, I'm looking at the business plan and the people who are actually going to execute that business plan. Now, let's go back to what a platform is. Now, all the platform is really doing is bringing deal flow to investors and then collecting fees the way, a broker does. It's basically a broker-dealer type situation. Does the platform, materially participate in the real estate activity that is involved? Are they investing? No. So when you invest in one of these platforms, what are you really doing? Do you know what you're buying? Well, sometimes, right? They'll be like, it's a multifamily building in, Oklahoma City or something like that. Wow. Okay. Like you're supposed to. Like every building's the same. Like every market's the same. Like ABC class. What's your value add? What is it? Well, you mean there's a million different things, right? In other words, do you know what the business plan is to yield these potential projections that are shown up on the screen? Well, not usually. Well, do you know who's operating the asset? In other words, listen, you're talking about commercial real estate here. Isn't there somebody who's actually going to have a business plan and make sure the business plan is followed? Like an asset manager of some type? Well, if you look at these platforms, you'd never even think that sort of thing existed. So the answer is almost never. I've never seen anything like that. And even if there was, would you get to talk to the operator? Would you get to know them? Would you get the opportunity to think, well, gosh, I really like and trust these people, and I think they've got integrity? No. You see, investing in real estate or any kind of real asset fund requires a different level of due diligence. And in my book, it always comes back to people, the people who are operating, who are going to run that asset, because investing in real estate is not like investing in stocks. It's not like investing in bonds or mutual funds. You see, people can invest in the exact same stocks online from anywhere in the world, and they get the same exact thing. So you can ask someone, hey, Buck, do you invest in Apple? What stocks do you like? And that actually makes sense, right? It doesn't make sense when you ask if you like a platform or if, what platforms do you use? Because then it's a very confusing question. Are you investing in a platform? Are you investing in real estate? Well, in the case of a stock, it makes sense, right? Do you invest in Apple? Well, I personally don't, although, I'm sure it's not a bad stock. And what stocks do you like? In my case, well, probably not really any. Except for maybe Berkshire Hathaway. And, I have this little thing with Facebook just in case they can actually make this quote unquote cryptocurrency thing work. But other than that, no, I don't. And so when I say that, though, when I say Apple, when I say Facebook, right, you know exactly what I am saying. And if you invest in that and I invest in that, we get the same results. That's just not how real estate works. And to be clear, these real estate crowdfunding platforms, they know that, right? They give you the same type of experience that you get on an E-Trade or something like that, so that you think the real estate functions the same way, and it starts to look, well, simple. And unfortunately, real estate isn't that simple. It doesn't have to be that hard, but I think it has to be more personal. And unlike Apple stock, there is an unlimited flavor of real estate equity out there, and it should not be mistaken for a commodity. You can't just go and click real estate. I'm going to add real estate to my portfolio, so I'm going to go click on it somewhere. You can't do that. A specific asset itself, like an individual apartment building, you can't even look at that narrowly. Case in point. So, I was recently, a few months back, in the best and final for an acquisition. It was a $25 million apartment building in Dallas that, we were looking at for our investor group. And great asset, and as it turns out, the best and final came down to two groups. So if you're confused at what I'm saying, the best and final, usually what happens in these things is there's a bunch of offers given, and then the seller picks a couple and says, you're the best and final, and give us your best and final offer. So that's basically what that is. So there was two groups here, and one group is a heavy value add player with a primary goal of creating forced equity and a large increase in value at sale for investors. They did not intend to make this property into a cash flowing asset, but they did see a great opportunity to increase its value and sell it for a nice bump and make investors happy. Now, the other team involved in that best and final was a team that was looking at this property differently. They were saying, well, gosh, You don't see very many of these buildings these days where you can potentially have cash flow from day one. So if we have a more modest value add play where we're doing things, but we're not pushing things quite as hard, we might actually be able to cash flow on this thing, maybe even double digits, and also create value. And to do that, you have to operate the building differently. Like you have to keep occupancies high and the rent increases go more gradually. So in the end, the cash flow team wins the battle. And of course, that property is performing very well. It's being run very differently than it would have been if the other team won. Of course, that doesn't mean that the other team would not have run it well. I think they would have run it very well, but the business plan would have been very different. And how do I know that? Well, in this particular case, I was on both teams in the best and final. And so I had an opportunity, a rare opportunity to see this property through the lens of two different business models. Now, take that example and go back to what we were talking about before. You cannot go to a platform. You can't go to E-Trade and say, I want real estate. You can't do that. And, bottom line is it's not about the platform. It's about the assets. It's about the people. It's about the business plans. And you have to understand a little bit of it, right? You have to understand a little bit of it. And once you get a little bit of it and you maybe find the right groups and the right people and they align with you, then you can kind of go on autopilot. I see financial bloggers, I hate to say it, but specifically some in the physician financial bloggers and self-proclaimed financial experts writing about these platforms as if they were specific investment opportunities. And frankly, they sound like bozos because they sit there and they review these sites like they're reviewing the quality of real estate or something. It's just insane. They just sound so stupid. But listen, so don't take advice on real estate investing from anyone who knows nothing about it. Okay, just don't do that. They're probably just trying to get you to click on a link and maybe they get an affiliate commission or something like that. But please, that's just not the way you invest in real estate. If you're going to invest like that, just don't do it. Just go get your little Apple stock and whatever you want to do. Because the other thing I hate is I hear about people saying, well, I invested in real estate once and it didn't work out, so I'm never doing that again. Or I invested in a syndication once and it didn't work out. And it's so ambiguous. It's not that easy, right? You have to look at these things individually. For me, investing is personal, right? It's personal. The majority of my assets are deployed into specific real estate holdings or funds that are run by specific people with a specific business plan. And in some cases, I make the decision to invest more because of the people involved rather than the asset itself. Now, a good example of that is this fund that I have invested in periodically over the last 6 or 7 years. AHP Servicing is what it goes by right now. But this is a fund that is in the non-performing note space. This is a space that I've tried to learn a lot about. I am no expert in it. I find it very difficult. And I think you have to be really, really engaged to do this at a higher level and at scale. So I understand what they do, but the note business is not something in which I would consider myself an expert at all. But I've invested in it a bunch of times. Now, would I invest in any old note fund? No way. No, because notes are hard, right? And I know they can make money for people, but if I'm going to invest in that, I'm going to invest with somebody I know, like, and trust and think is going to do well, who's got a track record to show it, somebody I think who's got great acumen in this area. And so that's why I invested in the past with AHP Servicing, because I know, like, and trust the founder and CEO, George Newberry. And George, who's been on this show a number of times, you may know he's one of the smartest and most interesting entrepreneurs I've ever met. He's really just a great guy, somebody I like a lot. I call him a friend for sure. And so I have no problem investing with George. And especially when he is at the helm, I feel very, very comfortable. And that's not because I'm just clicking the button on a non-performing notes fund. It's because George is at the helm and I understand the HP servicing model. So anyway, that being said, George is up to all sorts of interesting stuff. Like I said, he's one of the most interesting, dynamic entrepreneurs I've ever met. And when we come back, we're going to talk to George about all of his most recent activity and why it's significant to you. Welcome back to the show, everyone. Today, my guest in Wealth Formula podcast, he's no stranger to the show. He has been on, I don't know, like 4 times now. Definitely the number one highest number appearing guest on our show. His name is George Newberry, and he was one of the first shows we did. He is the guy who started AHP Servicing, which at the time, when we first started, was American Homeowner Preservation. He also has been on talking about a business venture called Debt Cleanse, and he's back again today, and we're going to talk about it all. George, welcome back.
Thanks, Buck. Thanks for having me. I'm glad to be your most frequent guest.
Yeah, you absolutely are. And,
I feel honored.
Yeah, no, it was great. And you know, George, is a disclaimer. George is been a sponsor of this show since the beginning, and certainly I got the best of that deal early on because George was was paying to sponsor me when the show was very small, even though it was potent. It was always potent because I think people resonated with the mission, and certainly the business delivered for people. But George, what is going on right now? You have been on, as I mentioned before, the last time you were on, you were starting this thing called Debt Cleanse. Maybe you could talk about that real quick, and then you can talk maybe a little bit about what got you back into really becoming the quarterback of AHP Services again.
Sure. So Debt Cleanse, to go back in the story, AHP started in 2008. We started crowdfunding in 2013. That's roughly about when we first met, and we transitioned in 2016 to Regulation A+ crowdfunding, which is the crowdfunding that allows anyone to invest, unaccredited and accredited investors. Minimum investment, $100. We try to make it as accessible as possible. What we do is we crowdfund the money, and we use that money to purchase pools of defaulted mortgages from banks and hedge funds. And we focus in the low to moderate income neighborhoods. So those mortgages secured by homes of, let's say, worth on average around $50,000, $40,000 to $50,000. And the reason we do that partially is because that's where the greatest social need is. That's where most of the hedge funds don't want to deal with it. They figure, hey, you're making, $8,000, $5,000, $10,000 a transaction. In their mind, it's not worth it. In our mind, if we can do that hundreds of the times, it makes it worth it. And it also, again, the social impact could be significant. And to give you context to this, let's say someone owes $100,000 and that home is now worth $50,000. We can probably buy that mortgage. In 2013, we could probably buy that mortgage for $20,000. Today, we can probably buy it for more like $25,000. But either way, it still gives us a huge amount of flexibility to offer that family either a modification with significantly reduced payment, reduced principal in some cases, and many a times they're behind a year, 2, 3 years, and we can reduce. They could owe $10,000, $20,000. We'll say, give us $2,000. We'll forgive the difference. And if they don't want to stay or it's already vacant, we give them cash. They sign a deed in lieu. We forgive the rest of the loan. We sell the property. In all cases, in most cases, we can generate a good return and also have a positive social impact. Now, 2 years ago, I was working unbelievable hours. The company just kept growing and growing, which is good, except I wasn't the great delegator, and I took on a little too much work, way too much work on myself, and it just never ended. And I was trying to keep everything going, and I came to the conclusion I needed to hire somebody else who would probably be a better delegator. I did hire a new CEO, and she took over in early 2008. Came from an institutional background
18,
and
you mean,
well-credentialed.
Right? 18.
What's that?
You mean 2018?
2018. Yeah, sorry,
Yeah.
in early 2018, and that she was instrumental in institutionalizing AHP, making us building a foundation for growth. But I think there was a bit of a disconnect when it came to the strategies that we employed. Again, buying these more challenged mortgages and rapidly getting them to some kind of path to a resolution, which spiked the returns. So in July of this year, just 3 or 4 months ago, I came back in as CEO, and what I've done is I'm going to keep the CEO position. I wasn't certain of that at the beginning, but I've decided I'm going to stay as CEO. And what I'm doing is I'm hiring the best team around me as possible, the best team I can find to surround myself with. And I've hired a president who used to work for Fannie Mae. I hired a vice president who used to work for Rocktop, which is a multi-billion-dollar hedge fund, which has historically been the number one seller of loans to AHP. Also, business development person, came from Rocktop, and right now I'm continuing. We hired a COO who came from a bank, which previously she worked for Davy Mortgage, which is a very large servicer. We've hired a number of employees from a servicer that's in our building, Face Servicing. So we're building this awesome team, but I'm staying at the top, and the goal is for me not to get to the point where I have to work the unsustainable hours as I did in the past.
Well, it's interesting because what you described, I think, is we've talked about this before. You and I share this curse called being an entrepreneur, and one of the things that happens with entrepreneurs is beyond multiple failures and significant stress to oneself and one's family, is that you get to a point when you build something where if you're not, there's a point where there's a fork in the road almost, where you have to say, well, gosh, if I want to get any bigger, if I want to, if I want to scale this thing, it requires skills that I don't have. And you did that, and you went out and got somebody. But one of the other things that happens sometimes in that situation is that the magic of the person who's the entrepreneur, the person with the special sauce, so to speak, sort of gets watered down. And I think for my sense is that for a year or so, that's kind of what happened. Obviously, the fund never lost money or anything like that, but the ability to create that magic, that high yield, was really a special skill that you had developed over some time, and you may have overestimated or underestimated your own contribution to that. But to me, what it sounds like is you have understood that. You've come back and you're like, okay, I'll be the rainmaker, I'll be the deal maker, but I don't need to do every last other thing I used to do, because most of that stuff is just paperwork and bureaucracy and so on. But what I'm really good at, I'm going to focus on. Is that about right?
That's a fair assessment.
Yeah,
absolutely. And I think the key is being willing to give up control, which is difficult. From an entrepreneur, you want to control everything, and it's really difficult to say, "Hey, please do this for me." And the other part is, I think, recognizing that there are people who have skill levels in different arenas that are can perform something much better than I can, and I need to get them on my team, reward them appropriately, and give them free rein. If they give them the goal, this is what we want to do, and they can help figure out the way to get there. And when they need my help, they ask for my help. Other than that, they're just working towards the goal. And as long as they're making steps towards that, the route they may take is not what I would have anticipated, but as long as they get there, that's fantastic.
So let's talk a little bit about, so at the end of the day, I mean, I just want to, just for people who don't really understand what notes are, you explained it, but in effect, what you're doing is you have mortgages that people aren't able to pay, and they might ordinarily get foreclosed on. But what a note buyer does is you're going in there and buying that mortgage from a lender, from a bank, et cetera, at a discount. And the inefficiency that George identified early on was that once those mortgages were purchased by an investor, sometimes they were they really didn't do things that made common sense, like negotiating with the person who lived there and try to keep them in their house and still being able to make a significant profit. So there's a social aspect to this as well. He found an inefficiency, and he was able to capitalize on it much more efficiently than hedge funds and other buyers of these loans. Now, so that is in effect what AHP has always been about. I will tell you that it's much harder than it looks, and I know this because I went out and I tried to learn this business from George. And I went in there and try to figure out what was going on, and there's a lot of moving parts. This is not easy. He makes it look really easy the way he's got this down, but it is not. But that being said, George, now let's talk about the market in general, because you mentioned that in 2013, this was, luckily for you in some regards, at the time of your scaling, when you were really getting good at this stuff, you had a lot more fudge factor. You had the ability, you had a lot more, probably some more margin of error. Since then, what has happened in the market to make it a little bit more challenging?
Yeah, so what has happened is just like in the real estate market and most asset classes today, a lot more competition. And I think as there's been a track record developed by us and others, that's attracted more money into the space. More money means and a lower supply. We're 10 years after the crisis. So after the crisis, there was just a massive supply. Now the supply is still there, but it's reduced significantly. And at the same time, you have a lot of people who've come in with more money. And when it's predictable, track record, people have been able to say, hey, I see less risk in this. I'm willing to take a smaller yield. And that's, we're dealing, there's hedge funds in this space that are willing to take a modest return, in the single digits on these loans. And that is, when they're willing to do that, we have to find ways to buy on the edges in order to still get the returns that everyone's accustomed to.
Yeah, and it's interesting too, because, when you're competing with, hedge funds and institutional money in general, they have a funny way of looking at things the way we probably don't as real estate investors. Usually their benchmark is, what the interest rates are, right? Like, as interest rates go down, they feel like they can accept less and less return, because they're effectively comparing it to, with treasuries, right? And so we don't do that. But then when you get in that situation, though, what do you do, George? What do you do? I mean, if you had to summarize sort of like what the magic, that you've brought to squeeze out more return than the hedge funds can, how would you describe it?
We try to buy what everyone else does not want. So that means we're buying the bigger problems, the ones. So, for instance, files that have that are missing documents, sometimes missing the whole file. We buy loans where they're secured by properties that are very low value. There's litigation on some of these files. So those we're walking into problems. We know they're problems, but we look to use our strategies to resolve them promptly. Whenever we can buy a problem and that no one else wants, we can get a better price. I mean, I'll give you an example. There's a pool of mortgage servicing rights. Now we're a servicer, we can buy mortgage servicing rights. And it's this pool we're looking at, it's very small. And so all the institutional buyers, they want to do big deals. And so these it's funny, usually you think in normal life, you think, okay, I buy a greater volume, I get a discounted price. And it's completely the opposite the way it's gone. Right. And now if you buy one-offs, there's local and private investor competition, but there's this kind of mid-range between the institutions and the mom and pops. And that's a space where, it can be a couple $1 million at a time, where there's a lot less competition. Then you throw in, hey, these loans have big problems. And now sometimes we can make very good deals. And I'll give you another example, speed and predictability. If you're a seller that's known to perform as promised, and people can count on it when you say, hey, I'm going to buy this and I can close on such and such a date, that's huge value. And about 2 months ago, we had We had a servicer call, and they had a pool where they said, hey, we need $1.5 million. We're willing to sell these out of a securitization, but you got to close in 5 days. And, most people just can't do that. And even if they can do it, they just don't have the comfort level to take that risk, because in 5 days you can only do so much due diligence. But A, we trusted the seller, and B, we looked at the pool and it just made sense. It looked like we were getting a great deal. And as it turns out, we got a great deal because we did perform. And then I'll tell you, this little pool of mortgage servicing rights, very small, 126 loans. So too small for most people to look at it. And then they say, hey, it was on this old servicing system and there's some problems with the data. So there's some inconsistencies. And so we were saying, hey, we're going to have to pay real cheap for it. In the end, they just said, they'll give it to you. I mean, you'll get to these points where people are just like, it's not, I mean, in the end, we're going to pay a token, or they're just going to give it to us because it's too much of a problem for them. They need to cut the liability, and we're going to have to do some work to clean it up. But in the end, we're going to make some money off that. And then think about this: mortgage servicing rights or loans, if you put them together into some homogeneous packages, large enough packages, now you can sell them to the institutions, and they're going to pay a premium of what you paid individually. So you're kind of, that's kind of a strategy to buy these odd lots, pick out stuff that has common characteristics that maybe they're reperforming loans, or now they've had a reasonable pay history recently, and we can sell those to hedge funds and then focus on the remaining ones that have more significant problems.
One of the things that you have to kind of think about a little bit. Now, you'd have a tremendous track record in terms of delivering. We can get specifically into the fund in a bit, but what your prefs have been over the last 6 years or so since you started, and you've been pretty well on target throughout that time. But on the other hand, if you think about it, people may be looking at this and saying, well, gosh, you're buying non-performing debt, right? So as an investor, how should I look at this in terms of the risk profile? Because that question, I think, is different for an investor buying a few notes compared to what you're investing in a fund like yours, right? I mean, what's the difference?
The big difference is that we are diversifying the risk. So we can buy 100 loans or 1,000 loans or thousands of loans, and knowing that we will lose on some individual loans. There's no question. If you're not losing, your strategy is too conservative, and your returns are going to show it. But you will, if we buy 100 loans, I'm going to expect on average we're going to lose on 10 of them. And it doesn't mean we lose everything, but we're going to get less than what we paid for them. And that will happen. But now we can absorb it, and those other 90% will more than make up for the ones that we lose. Now, what's challenging is for an individual investor, they may buy 5 loans, and maybe all 5 work out, but maybe 2 or 3 of them don't work out as planned. And all of a sudden that investor looks, hey, I spread my risk over 5 loans. 2 or 3 of them didn't work out. All of a sudden, hey, I lost money on this thing. I'm not going to do it again. And the more loans you buy, the greater the likelihood that you can spread the risk over multiple loans, because it is, like you said, it is non-performing debt. It doesn't mean, there's going to be challenges. So people don't want to pay it in most cases. And many cases they're not paying now. And you need to make it, in my mind, you need to create the proper incentives to align the interests of the homeowner and the fund and the servicer, for that matter.
I can just say, like, personally, I bought a couple of notes, and they didn't even look that bad, but boy, it's been a struggle. And just, again, the comparison to that versus spreading risk in a fund, many thousands times over is I think where the value comes from in something like this. So tell us about the current fund. What's going on with that? And I know you're opening up again, or you already have opened up.
Yeah, we opened up a week ago, and we are just less than a week ago. And just because here's a challenge. Another challenge is when you are a fund, as you raise money, you need to promptly deploy it. If the money sits in the bank, that's going to drag the returns. Even if you're doing great on the money that's invested, you have too much money sitting in the bank earning almost zero, that will drag your returns. And we had that issue when I came aboard. There was a lot of money sitting in the bank account that had not been invested. So that's why it took a little while.
When you came back, you mean, right?
When I came back as the CEO.
Right.
Yep. So at this point, that money has been deployed, and I've lined up enough deals. I think that through the end of the year, we can promptly deploy the money as it comes in, and that is, and keep going forward, and that's key. You can't. I mean, if the supply ran dry again, we'd have to close the fund again. But I think for the next through the end of the year, it's a great time to be buying. People are motivated by urgency to close it by end of month. By end of year. And that is something I think we'll be able to take advantage of.
So what's how big is this fund? How long does it go?
Sure. We can raise up to $50 million a year. And our first year anniversary was last week in early November. And our next, so we have until November of 2020 to raise another $50 million. I think we're going to do it. I wouldn't be surprised if we hit that limit by, say, March or April of next year.
Yeah. And so in terms of an individual investor, you mentioned a couple things that I think were key. One is, unlike, a lot of the opportunities that we certainly do in our accredited investor group, this is open to everybody. You don't have to be accredited. The minimums are ridiculously low.
That's by design.
Yeah, and how low is it? What's the minimum?
$100.
Yeah, okay.
Is the minimum investment.
This is like, I can't imagine how you would actually make money taking $100 at a time, and I suspect you probably don't. I mean, just with accounting costs alone.
Agreed. On somebody who invests $100 and that's it, that probably is not a winning proposition. We look at it as a marketing tool, though. There is so many people invest $100. And that's just the start. And I can think of one investor who started with $100 and now they are at $1 million.
Wow.
But they just tried it. Hey, this sounds interesting. $100. Yeah. People think that's, dinner and the movies on the weekend. I can throw that in and see what happens. It worked out well. And a couple of years later, people start increasing. I think our average investment is around $7,000.
Yeah.
But there's a lot of $100 investors, and some of them, that's it. But it is, now they're tied to it. They get our emails each month. They get to keep track of what's going on in the fund, and hopefully either they'll invest more or they'll tell their friends and family.
Got it. And then what is the preferred return? How is that distributed, et cetera?
Sure. We pay investors the first 10% of what we earn, and that is distributed monthly on the roughly the 10th of each month. You can choose in the first 2 years of the fund. We're able to reinvest that money. After that, we have to do the monthly distribution.
Got it. And in order to sign up for that, what is the website? Because there was a little confusion, I think, before when you transitioned from the last fund. Like, how do you sign up for this?
Sure. So the place to go right now is ahpservicing.com. And that is where we have a current offering available. The prior fund that we did that was Regulation A+ is under at ahpfund.com. And so and we still have that fund up. We still have that website up because people can go and log in to see their investment history there on the prior fund, and now it's AHP Servicing. At some point in the future, because we expect to do another, additional Regulation A funds, we have at least one more planned for next year. We need to, at some point, it'd be nice to just have one site for investors for all the funds. 100% agreed.
I've found myself, because I've been an investor in the previous fund and the current fund, and it just created a massive amount of confusion. But just for clarity, I'm going to say it again, ahpservicing.com is where you need to go now, correct?
Correct.
Okay. AHP Servicing. And one of the key things that I think is probably one of the most unique aspects of this is the liquidity issue, because ordinarily, there's funds out there that they may be distributing a certain amount in the note space, but they don't really have the opportunity for liquidity. Can you talk about that? Because that's, I think, one of the biggest selling points for this fund.
Absolutely. So we offer best efforts liquidity. Basically, that means that an investor can ask us to redeem all or part of their investment, and we will undertake our best efforts to do that within 30 days. Historically, we've done that within 30 days under my management, under the prior management. There were a few times where it took longer, and I apologize for that. Since I've been back on board, we've been able to get everything done within 30 days.
Yeah, and let's just, one last thing I want to ask you about, because, we've talked about sort of the frothiness of the real estate market that sort of spilled over into the note market as well. Now, how do you, if there is a correction in the market, is it actually good for what you're doing, as opposed to, we should be worried about it?
No, good. Disruption is good. Downturn is good for us as in terms of fund performance. I mean, we don't want to hope for challenges that people will struggle, because that's not what we want to have happen. But inevitably, there is a cycle to this, and right now, there's many pundits believe that we are at the tail end of a very long upcycle, which will result in a downturn at some point, and that will impact both the real estate markets and certainly, by extension, the distressed mortgage market. And what happens in that situation is the value of our current holdings will probably go down, but that will be mitigated by the fact that the majority of what we buy is secured by lower value homes, which should not fall as much as the higher value homes. But also, it will increase our purchasing opportunities significantly. Right now, as we talked, there's a lot of money is flowing into this space. There's a lot of predictability, and as soon as there's a downturn, there's disruption, there's uncertainty, unpredictability. That money, some of that's going to go to the sidelines. Hey, wait, let's see what's going to happen here. And then the supply increases, then there's more loans for sale. So that's always the best market to buy in any type of situation. Again, real estate, notes, businesses, debt. Anytime where the supply exceeds the demand, prices will drop and opportunities will rise.
Yeah, I mean, the reason I bring that up is because I think that in some regards, what you're doing right now does provide some, if you think about it, a sort of hedge against setbacks in the economy, because effectively, you're buying right now and you're performing. Even if there's a situation where you may have to go back to some of those previous properties, the opportunity to go in and buy other things at a discount, if there is some sort of additional, setback or recessionary activity, gives you an opportunity to almost volume average, what's going on a day-to-day basis. Does that seem about right?
That does seem about right.
Yeah.
I mean, we were there when we first started. We were in our formative stages, and we were buying from the biggest banks in the country. And the only reason they were selling to us is because there were so few buyers. And we were a very small buyer at the time, but Citibank, Banco Popular, FDIC, big hedge funds and banks were selling to us. And that was a reflection of the times. Now, 6 years later, some of those banks won't sell to us, not because they don't like us, but because we don't have $100 million, which other people are able to put together, buy these $100 million pools, and we just can't do that. And I don't think I want to do that, because they're going to get better pricing when they sell to the guys who can do $100 million trades. But what happens, though, is those hedge funds that buy those $100 million trades, then they end up selling to us. But take those out of the picture, we're back buying directly from the banks, and I see that happening during the next disruption.
So I'll just say this much. I think for me personally, having George Newberry back in the pilot seat at AHP Servicing is huge. I think for anybody who's not who's interested in sort of a cash flow fund, where you literally, it's what cash flow is, right? I mean, it is a monthly distribution based on a fixed number. In this case, typically, I think we have 10% now. And that opportunity, if you're looking for that with George in charge, I think it's one of the better opportunities, in my opinion, to go out there and consider, especially with the liquidity option, because effectively it becomes almost like a extremely high interest bearing account where you can access money at any time. George, anything else that I left out that you think is important for us to know?
Hey, I'll throw you on the liquidity, and I agree. It's been attractive, and what happens is a lot of investors who maybe buy and resell homes or apartment buildings will come out of an investment. They park the money at the bank, and they get almost nothing. They can invest it with us, and then they find another opportunity, they can redeem it, and that's worked well for, I think, a lot of people. But do add that the caveat that if they do redeem it in the first year, that 10% drops to 8%, and in the second year, it drops from 10% to 9%. So just be aware of that for your listeners.
Got it. Again, that is ahpservicing.com, everyone. George, as always, it is a pleasure. And we're looking forward to working with you again in the Wealth Formula community.
Likewise. Thanks again for having me on, Buck.
We'll be right back. Welcome back to the show, everyone. Hopefully you enjoyed it. As always, George Newberry is a friend of the show. Highly recommend that if you're looking to get into the cash flow game, looking for that, really aren't looking for necessarily a lot of capital gains or capital growth, or somewhere to park your money for a period of time, this is certainly something to consider. And I've used it in all of those capacities in the past. Now, one thing, before I go, I want to remind you that a number of people email me all the time with questions and stuff like that, and I'm happy to answer as much as I can. But one of the things that if you really want to get involved with the community where you can get a lot of your questions answered and run things past other people, I would highly consider joining, or at least considering joining, the Wealth Formula Network. Wealth Formula Network's a private group, and you can find out about it at wealthformularoadmap.com. But it started out initially as a course. The course itself is got a lot of the names we always talk about in here: Tom Wheelwright, Ken McElroy, those types, real smart people. And then once you get done with the course, or simultaneously, I should say, you are part of this group called Wealth Formula Network, where we have bi-weekly Zoom video calls, and we have a private Facebook group and also a portal. We share information with each other on a Dropbox. Just lots of different things available. And if you're the right person for this, it can be a really, really rewarding thing to be part of. Who's the right person? Well, I would say if you love this stuff, you like talking about it, your neighbors are not really into it, your friends are not really into it, and your wife or your husband does not want to talk to you about it, then you should seriously consider joining us, because that sounds like the rest of us. Anyway, again, that's wealthformularoadmap.com. Would make a great Christmas present this year, too, to somebody. So anyway, that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.